Liquidity is all about how quickly and easily you can turn something into cash without losing value. Think of it like water. The more liquid something is, the more easily it flows. In finance, cash is the most liquid asset because you can use it instantly. For example, money in your wallet is 100% liquid. Money in a savings account is very liquid. Selling your car is less liquid because it takes time to find a buyer. Selling a house is even less liquid because it could take months. So in short, liquidity equals to speed plus value stability when converting to cash. Why liquidity matters? Liquidity matters for three main reasons. For individuals, imagine you lose your job tomorrow. Can you pay your bills and buy groceries? That's where liquid assets like savings or emergency funds save the day. For businesses, a company might look profitable on paper, but if it can't pay its employees or suppliers on time, it's in trouble. That's called a liquidity crisis. For investors in the stock market, liquidity determines how easily you can buy or sell a share. High liquidity means lots of buyers and sellers, quick transactions. Low liquidity means you might have to sell at a loss just to exit. Types of liquidity. There are mainly two types of liquidity you should know about. Market liquidity. How easily assets can be traded in the market. Example, the stock market is usually very liquid, but rare real estate or collectibles can be hard to sell. That's low liquidity. Accounting or business liquidity. This focuses on a company's ability to meet short-term obligations. Can the business pay its bills in 30 days? Does it have enough current assets to cover current liabilities? The liquidity ratios explained. Current ratio. The formula is current assets divided by current liabilities. If a company has $10 million in current assets and $5 million in current liabilities, the current ratio is 10 divided by 5 equals 2. That's healthy, meaning the company can pay its bills twice over. Quick ratio, also called acid test ratio. The formula is current assets minus inventory divided by current liabilities. Why remove inventory? Because it might not sell quickly. A ratio above 1 is usually good. Cash ratio. Formula is cash plus marketable securities divided by current liabilities. This one is the strictest. It checks how well a company can pay short-term debts using only the most liquid assets. Liquidity versus solvency. Now here's a common confusion. Liquidity is not the same as solvency. Liquidity is about short-term survival. Can you pay your bills this month? Solvency is about long-term health. Can your assets cover all debts if the business closes tomorrow? A company can be profitable but still face a liquidity crunch, simply because cash is not coming in fast enough. Managing liquidity. Here's how individuals and businesses can manage liquidity effectively. For individuals, keep an emergency fund of at least 3 to 6 months' expenses. Avoid locking all your money in long-term investments. Keep some cash or savings for unexpected expenses. For businesses, monitor cash flow weekly. Maintain a balance between credit sales and cash reserves. Use short-term financing like overdrafts or credit lines wisely. Don't overstock. Inventory can trap liquidity. So, to sum up, liquidity is not just a financial term, it's the lifeblood of every business, every investor, and every household. You don't need to be rich to understand it, just smart enough to manage your cash flow wisely. Remember this golden rule: profit shows success, but liquidity ensures survival. If you found this video helpful, don't forget to like, subscribe, hit the bell icon so you never miss more simple explanations of complex business ideas. And this is the end of this video. Thank you so much for watching.